Good morning. You're watching The Market right here on ET Now with me, Ayesha, Faridi, Avanne, Dubash, Ajaya, Sharma on the show right now. And for our markets, the struggle continues. Little bit of consolidation, little bit of dip, but we're maintaining those support levels, at least so far, that of 19,300 thereabouts. But having said that, we're set to close this week at a 5-week low, sub the 19,400 mark, and there's no taking away from it. In fact, the last 2-day gaining streak, remember yesterday as well in the latter half, we did manage to eke out some gains and did rebound quite smartly actually from the session lows. That also caved in yesterday when you had a flat start, and then we only tumbled from there about 0.5% or so. It's the blue chips which are actually a big drag. So your Reliance Industries, ITC, HDFC Bank, they are the ones which have been tumbling. Having said that, good amount of traction in some of the Adani names, Titan, SBI, etc. But you can't really pull out any trend besides the meaningful move in the Adani names that you saw in trade yesterday. The market breadth, though, that continues to be lively, and that continues to favor or hold out as opposed to what the benchmarks have been up to. That continues to be in favor of the advances. And many stocks within the broader markets, the mid and the small caps, which continue to hold at their 52-week or all-time highs. It's the PSU Banks Index, once again, which has been powering for a second session ahead. So, I mean, in all honesty and fairness, Ajay, we managed to put up a brave fight, irrespective of the FIIs selling and the macros not looking as robust as they were even 15 days back.
In fact, global macros have turned worsened. They're worsened actually in the last 3-4 days. And we are braving that. That is something to watch out for. My only fear is that if you look at Monday's and Wednesday's trading action, you would see that there was almost over 100-point intraday rebound on the Nifty, almost 300-point intraday rebound on the Bank Nifty. Yesterday, we did not even attempt to do that. So for a third day, we actually succumbed to the pressure. Look at that. We ended near day's low. Also, what is important to watch out for on technicals is that week before last, the intra-week Nifty low was closer to 19,200. Today's litmus test, are we going in that direction? And similarly, on the Bank Nifty, 43,700 was the intra-week low week before last, when there was a lot of bad news which had actually come in. So are we going to retest that? That would really be a weakening of market technicals. The only good thing is that there's a lot of concentrated flows going towards mid-caps. Not only, of course, there's a very interesting Goldman report which we'll be discussing how there's a lot of concentrated buying in mid-caps by FIIs, and this is happening after 5 years of net outflow. We are seeing addition happening as far as their weightage is concerned. But wherever there's good commentary coming in from results, wherever there's very good evidence of good quarterly earnings, those are the stocks which are really outperforming. And yesterday too, we clearly saw mid-cap, small-cap indices put up a very brave show despite of large caps buckling under pressure.
Yeah, and through, the mid and the small caps really showed their resilience even after the fact that we wrapped up a 0.5% lower for the frontline indices. You did see a very marginal gain though for the mid and the small caps by the time we shut shop. I just want to give our viewers a better picture as to what the global setup is this morning, because yes, we were saying that the global macros are also worsening. You've also got the global markets which have been declining for 3 straight days on the trot. That's the picture just last evening. You incidentally have the Dow Jones which closed below its 50-day moving average for the first time since the 1st of June. So that's a bit of a bearish signal as well for investors, and it's on pace for its worst week since the month of March as well, which is lower by nearly 2% just yesterday. You've got the Asian markets as well, which are on the back foot, and that's largely on the back of the core inflation in Japan that's fallen. But yeah, Ajay was making the point about the FIIs now coming back to a lot of those mid-cap stocks. And as per the Goldman Sachs report, they have increased their weightage, in some sectors like consumer durables, autos, real estate, and names like AU Small Finance, Max Healthcare, Axis Bank, all featuring on their radar.
Yeah, that's correct. These are the large caps. But if you look at the areas within the mid cap which they have increased, then you would see they are more domestic-centric kind of sectors where there is clear evidence, resilience in numbers and confidence in management commentary.
Yeah, absolutely. And, you've seen an increase in FI ownership when it comes to consumer durables, when it comes to autos, when it comes to real estate. So, it's actually the consumption-facing names which are seeing, ownership increase.
Clearly. I mean, we have very high superior demographics, right? And it is very clearly evident. Talking about one more section, within the autos, it is actually the auto ancillary where FIs are hiking their stake. And within the real estate as well, they also term a lot of materials in the real estate pack. So cement, home improvement, all of that, the ancillary plays is where we are seeing very clear distinction between on a gross number, FI selling continues, but on a net number, India dedicated number. In fact, today also, right in the morning, Bloomberg has put out a report that dedicated flows to India are actually at 1 month high.
Yeah. And you know what's interesting is the favorite FI stocks, Ajay. I mean, you know, you did talk about auto ang. So yes, Sona BLW does find mention there. But look at the nature of the financials. There's Shriram Finance, there's Axis Bank, and there's AU Small Finance Bank.
AU is a very, domestic mid SME kind of a lender. Shriram, again, is the auto play actually.
Yeah.
Of course, now after the merger, it's become a much more larger NBFC, but largely it was a very domestic-centric, personal, I would say, domestic-centric auto lender, but now it has a retail play as well after the merger. So this is interesting, but I would love to see the small and mid-cap name, which they would have actually got. We'll have to do a little more work on that.
Yeah, we'll dig that out for sure. But of course, you know, like Avanne highlighted, it is a day of weak global handover. So you'd have to see the Nifty implied open is already indicating a 75-point downtick, although the GIFT Nifty is indicating a marginal upside, but this is going to be a little tricky. To the point that we were earlier making, you know, what the markets are now drawing cues from is where the inflation print is headed, what the RBI commentary is, even at a global level. And to the RBI bulletin, Ajay, they're saying that headline inflation is going to average well above 6% in the second quarter too. They're saying the genie of inflation is still out of the bottle. Shadow of El Nino looms over the second half of the year as well. Another upside risk is the outlook on crude oil prices. Less probability of oil prices pressures easing. So clearly building a scenario that inflation is not transitory in nature and it's going to continue to hold at a high rate even in the second half.
This is very important commentary, Ayesha. And the reason I brought it up was that this is the second time in 15 days after the RBI policy that RBI is actually preparing the market, preparing the entire ecosystem, that if you were really, in the kind of a camp which was believing that it's a pivot, well, it may not be a pivot. Actually, it may just be a pause. And that's not only the case in India. Globally, too, central bankers and most of the policymakers are preparing everyday commentary coming in that until and unless there's clear evidence of data really suggesting that inflation genie is under control, don't expect any rate cuts or a long pause. But we have Taimur Beg, who's MD and Chief Economist at DBS Bank, to help us understand the impact of the global risk-off, which has just turned, accelerated in the last couple of days on financial markets. Taimur, morning. Thank you very much for your time. Let's start with China. A lot of bad news coming in over there. Now, again, very large realty players like Evergrande, all of that, have filing for bankruptcy. Just a few days back, they had kind of released a little more stimulus into the system, giving a sense to the world that things are really very dire in China. Let's start with that. How do you gauge the bad news coming out of China?
I think there's no sugarcoating the narrative out of China. The mountain of debt around the property sector is substantial, and it is having a major impact on investment sentiment, on consumer sentiment. If you're on the buying side of the property as a consumer, you will worry that the value of the property may not be holding up, or you may not even get delivery of the apartment that you're waiting for. And if you're in the building side of the equation as a builder, you are probably worried about the debt that you've taken to build, whether you can service it or not, whether the next time you refinance, how much interest you would get from your creditors. So it's a bit of a spiral, if you will. Both the buying sentiment as well as the building sentiment is very poor. Normally, these things do not necessarily get ameliorated by 25 basis points of rate cut. You need much more than that, a major proactive debt restructuring with full participation of the private sector. One thing I'd like to hasten, and this is a truism that holds across geography, is that when you have a large bad debt situation in the property sector, whether it is the Japan story from the 90s and 10s and the US story in the teens of this century, you need strong involvement of the private sector, debt restructuring funds, so-called voucher funds, and so on. So China would need global investors to get excited about the debt restructuring story there. There is sufficient capital in Hong Kong, in the US, in Europe, and within China as well. If they want to get the private sector involved, where bad assets are restructured, repackaged, given in the hands of those who are professionally very successful, they have a track record of successful restructuring, I think the economy can turn around. It happened in the case of Japan. There's no reason it cannot happen for China. there are political considerations, there are geopolitical issues. That I think is coloring the matter substantially. And I would like to also end this point by saying that global investors are not completely shying away from China. I think that's a narrative that needs to be corrected because I think we have seen a few too many articles in recent days saying US firms are scaling back on China. Well, US is not the only source of capital as far as China is concerned. As I said earlier, you've got quite a bit of capital sitting in Hong Kong. Sovereign wealth funds in the Middle East have shown quite a bit of interest in China. And therefore, when we look at monthly capital flow data, July was actually a pretty good month for China. It was not a very good month for Chinese markets, but as far as inflows, FII inflows are concerned, they were pretty decent.
Right, that's quite interesting. But would you say, Taimur, that that's largely a play on valuations looking quite ripe for China right now? Because, there's nothing that seems to be indicating that China is out of the woods.
Right. You can always say valuation gets cheaper if the macro story doesn't turn around. So, no, I think that one could have made some compelling arguments for Chinese equities being good value maybe 6 months ago. And they've gotten actually cheaper since then. And that's where I suppose the policy imperative comes in. Going strictly by valuation perspective, there should be a lot of interest in China. But clearly, it is not the only valuation dynamic that is involved here. The inclination of the authorities to allow the private sector to find the right price, allow them to have some unfettered movement of capital, both in terms of purchase as well as liquidation of assets. That's where I think the market uncertainty is still substantial. Until that is taken care of, it can be cheap. It still may not be attractive.
Taimur, hi, morning. Wanted to also get in your take on, things back home. The state of the economy is flagged off by the RBI in their bulletin. And, they're clearly talking about how now there's a less possibility of oil prices easing and that the shadow of El Nino looms. And the fact that the genie of inflation is still out of the bottle. Headline inflation still above 6% for Q2.
I have limited worry about this matter. And some worry, of course, I get paid to worry, so some worry, but not a lot of worry. Even last year when we had tremendous amount of anxiety about food and energy security worldwide when the conflict in Ukraine broke out, we eventually saw heroic supply side response, heroic response in terms of transportation solutions to take excess wheat or oil or gas from around the world and take it to the places where there was a demand-related uncertainties. And therefore, I don't think that issues related to El Nino or OPEC cuts or lingering tension in Ukraine would be the spoiler for inflation again. It would probably stop inflation from coming down the way we were hoping. It may force central banks to maintain that so-called higher for longer narrative, but it would not lead to another round of rate hikes. Absolutely not. I think the amount of monetary tightening we have seen around the world, it will be felt for months, if not years to come, in terms of higher cost of funding, in terms of difficulties of maintaining margins. So I think there's been sufficient tightening worldwide, including India. So RBI signal, which is they need to be careful about inflation, absolutely valid. But at the same time, I would not necessarily read that as saying we're going to be hiking rates substantially. It's more like we'll keep rates where they are. Don't expect rate cuts. I think that's what we need to take away.
Appreciate your time, Taimur. Thanks so much for joining in and giving us a view on macros globally as well as back home. All right, let's take stock of our own markets. Let's talk levels. We've got Naresh Mirani as well as Kunal Bothra right here with us in our studios. So Kunal, what's the view on the index given the fact that yesterday there was no attempt to even pull back? We were at a 5-week low and it seems like the heavyweights are really contributing to the declines.
Well, yes, Avanne, and I think the pressure from many of the large cap stocks, banking names, particularly on one side, I think all of that added pressure to the indices. Lack of bounce from the two major stocks, Reliance and HDFC Bank, which we've seen I think day before, I think also added to some bit of nervousness as well as pressure on the markets. But I believe that it's still we're still into that phase where the index is going through more of a drag on a regular basis rather than a very sharp kind of a correction, because had it been a more sharper kind of a correction on the indices as well as overall markets, we would not have seen a lot of mid caps and small caps tend to outperform. There are still a lot of opportunities in terms of stock specific where we've seen mid caps and small caps rising up higher, making new highs, carrying on the momentum. So this could probably be a phase of a correction. Yes, I think 90,300 is a very critical and important support. And if we manage to break and sustain or as well close below this level today, then I would believe that we could be probably another 300 to 400 point correction on the index.
Right. Naresh, what is the large cap selling yesterday telling you? Does it seem like the market is headed lower?
So the drift has been lower. The problem is the broader market is not bad. We are seeing the heavyweights taking much of a knock. So if you look at a stock like Kotak Mahindra Bank that has corrected back from 2000 to 1750 levels. You have HDFC Bank which is corrected from 1700, 1730 to sub 1600 levels. Reliance Industries tried to make a comeback, could not do so. So overall, the heavyweights continue to be in problems and ITC has also fallen. So the case is we are slowly drifting lower. Now 19,250 to 19,300 was the low made where we saw bounce in the last 2-3 sessions. If that breaks, we go and test that 18,900, 19,000 levels. That is where we saw the major gap up and where the trend started, the momentum started towards 20,000. So for now, it's a drift, it's a classical correction after a move from 16,800. So for now, what we are seeing is we'll see more weakness only when we start seeing the broader markets also react. The breadth also gets weaker. As of now, that's not the case. So for now, we take it as a place where you just wait and watch and play defensive till the time we either make an oversold zone towards 18,900, 19,000 or make a reversal in a sharp way.
Okay, let's get stock specific then, and Kunal, find out what exactly your strategy is for the day. You've got a buy and you're tilting towards the financials.
Yeah, tilting towards financials, and so specifically one of the stocks which I would repeat from yesterday, Manappuram Finance, had given as a buy. The stock did pretty well for itself, closed at the high point of the day at 154.55 mark. I think if I'm not wrong, the stock is almost out of the F&O ban as well, so that should probably propel the move further for Manappuram Finance going forward. So maintain the upside expectations for Manappuram Finance, raising the targets marginally higher to 160. Traders could look at a fresh buy, stop us at 150. And the second would be a buy on J&K Bank. We discussed this in the chart busters yesterday. The stock showed absolutely strong momentum, closing at the high point of the day at 87 plus mark. So expecting this strong momentum to continue, 92 as a target, stop us at 84.
Before we go to Naresh, I have a quick view. I want to discuss one point, Kunal. Yesterday we saw 11 stocks coming in F&O ban, which is the highest number we've seen in many series.
Yes.
Is that also an indicator kind of that the trading janta is very active right now and the market is actually turning on the other side?
But the problem is, Ajay, that most of the activity which is happening into the stocks are the ones which are in F&O ban. So if you want to, for example, go long on Manappuram, you can't go long on the F&O.
So you have to buy in delivery.
You have to buy in delivery.
Yeah. Or a Z the day after the merger.
Exactly.
Yeah.
Even India Bull Housing.
Yeah.
All the stocks which are in high activity, they are the ones which are in F&O ban.
Interesting. Yeah. Naresh, what are your trading ideas looking like? And do you have any short idea as well?
So not looking at shorts, but I'd like to add on the derivative part. The problem is not the speculative positioning in India. The fact is the arbitrage funds now today at 95,000 crores. And in a lot of cases, 20 to 40% of the futures OI is arbitrage funds. So that takes away a lot of market-wide position limits. And wherever there is volatility, that is where the yields are. And that is why we are seeing the list increasing. So a little bit of a speculative activity via options and stocks go into ban. And we have a very tight market-wide position limits on derivatives in India. So that's the case. So it becomes a double whammy. Arbitrage funds have been seeing inflows and speculative activity is happening more on the smaller market cap side in F&O. So that's the case. In terms of stock picks, I would be looking at first a buy on Mahindra and Mahindra. The stock has continued its pole position in the auto pack. The stock has recovered back sharply, very close to new all-time highs. We've seen Escorts Kubota make a new all-time high. So the trend is very clear for the sector. So out here could see a dash towards 1700 plus levels, stop loss at 1530. Second is a buy on Oil India, which has made a clean breakout and has continued over the last two sessions. It's a multi-year breakout here, stop loss at 275, target price of 350.
Right, okay. Those are some interesting stock ideas there. Let's also get you a view from Nilesh Shah from Envision Capital as well as Hiren Vaid from Alchemy Capital, them sharing their top ideas in their portfolios.
Yes, we have NBFCs and financials at the top, but we also have consumer companies like United Spirits is part of my top 5. Varun Beverages are top 5. We don't look like the index at all in our top 5-10. We are bullish on Paytm and Zomato. We also like Policy Bazaar. Zomato could compound top line for the next couple of years, and if they start becoming more profitable than what they are today, then I think that's where the value, that's where the money is going to be made.
I think if they continue to do what they do currently, I think they have a great chance of being an outstanding bank. The big lever which they have is the cost to income ratio. For IDFC First Bank, it's at 70 to 75%. If over the next 5 to 10 years, if they can basically bring down that 70-75% to 40-45% and keep growing the loan book at maybe just about 20%, that can translate into some really nice compounding earnings growth for a long period of time.
I'm not as bearish on tech as most people are. Yes, we are going through a slowdown patch, but my sense is that AI will actually accelerate tech spending. I think that every company will have to adapt AI into their processes, and they will need products and tools and Indian IT services companies to help them to use that AI into their businesses, right?
Currently, one company that we've just recently invested in, we own it, is essentially MapMyIndia C Info Systems, which went public, I think, a year and a half back. I think so again, coming back to technology, I still think that there are several opportunities in the broader market. I think if you take your eyes off the top 3, 4, 5 names and look at maybe some of the other companies, I think there are interesting opportunities. LTTS is something which we continue to own. Newgen is something that we have liked, and I think it's a very interesting company also.
All right. On that note, it's time to slip into a very short break. Don't go anywhere. Lots of stock-specific action coming up.
All right, so NSE and FTSE have announced a rejig in its key indices. What exactly are the inclusion and exclusion, and what are the kind of inflow-outflow are those particular stock likely to face? Somit is here with more on that. Somit?
Well, if you see, NSE has announced its changes to the indices, while FIIs is expected to announce the changes today later on the later half. Now, firstly, on the NSE front, if you see, they have announced no changes when it comes to Nifty 50, Nifty Bank and Nifty IT Index, but there have been 5 stocks that have been added and 5 stocks that have been removed from Nifty Next 50. Now, on the exclusion side, there is ACC, Nykaa, HDFC AMC, Indus Towers and Page Industries, while on the inclusion side, there is PNB, Shriram Finance, Trent, TVS Motor and Zydus Life. Now, owing to passive fund flow for stocks like Shriram Finance, inflows are expected of close to $56 million, which is nearly 1.4 times its average daily volumes, 20-day average volumes. When it comes to Trent, inflows are expected to be in the range of around $44 million, which is nearly 6 times its 20-day average volume. Then there is Zydus Life, which is expected to see an inflow of around 19 million, which is nearly 3 times its 20-day average volume. Now, on the side of exclusion, there is Page Industries, which could see an outflow of close to $27 million, which is nearly 3 times its 20-day average volume, while there is HDFC AMC, which is also expected to see an outflow of close to $24 million, which would be nearly 1 times its 20-day average volume. Now, when it comes to FTSE, they are expected to announce changes. There could be fresh inclusions and exclusions in the all cap and the all world indices. However, the adjustment regarding these changes will happen on September 15th. Now, 2 stocks that would be added would be moved from all cap to all world index, that is KPIT Tech and AI Engineering. Now, because of this, there are inflows expected to be in the range of around $35 to $45 million, which is nearly 2 to 8 times that 20-day average volume. Then there is Syngene, Mazgaon Dock, RVNL, Apar Industries, which are also expected to be added to the all cap index of FTSE, and there could be inflows in the range of around $12 to $22 million. 2 stocks that would be removed from the all cap index, that is Hudson Agro and Brookfield REIT, while there would be some quarterly adjustment when it comes to HDFC Bank because of the merger, and then there is Kotak Mahindra Bank. Now, because of this adjustment, HDFC Bank is expected to see an inflow of close to $552 million, which is nearly 1.4 times its 20-day average volume. Then there is Kotak Mahindra Bank, where there could be inflows in the range of around $80 to $83 million, which is nearly 1 times its 20-day average volume. So keep an eye out for all these stocks in trade.
Right. Right. Samit, since you do track the oil and gas space as well, we understand that the government might be considering lowering excise duty on petrol and diesel, right? What would it mean for both these players and, of course, for the economy per se?
Well, news reports are suggesting that government might consider lowering the excise duty on petrol and diesel. Now, the excise duty has remained unchanged from May 2022, and post the last cut that we had seen in last year, excise duty was back at pre-COVID levels. Now, if you remember, during COVID times, government had increased the excise duty, but post the last cut, current excise duties that have been charged on petrol and diesel are largely at par with what it was during the pre-COVID. Now, how will this cut benefit? Now, this cut in fuel taxes will help cool the retail inflation, and because of this cut, also fuel prices will come down, which will in turn reduce the logistics cost, which and again will help cool the inflation. Now, inflation for the month of July stood at a 15-month high of around 7.44 times, and even last time when we had seen inflation rise to an 8-year high in April 2022 that at around 7.79%, government had gone ahead and cut excise duty on petrol and diesel by around 6 to 8 rupees. So again, government is expected to do so because the inflation is at a 15-month high. Now, what could be the impact on the government finances? What experts are saying is that this could put pressure on India's fiscal deficit target of 5.9% for FY24. Now, last time when the government had reduced excise duty on petrol and diesel by around 6 to 8 rupees, the revenue loss estimated was close to 1 lakh crore rupees. However, on the oil marketing companies and city gas distribution companies, the listed companies like IOCL, BPCL, HPCL, Gujarat Gas, IGL and Mahanagar Gas, the impact is expected to be negative. Now, for oil marketing companies, it will be negative because they'll have to completely pass on this benefit to users. And even last time when the government had cut excise duty, the oil marketing companies had to bear an inventory loss on their books. So hence this could be a financial impact, could be negative for the oil marketing companies. And when it comes to city gas distribution companies, it is sentimentally negative because competing fuel like petrol and diesel are expected to become cheaper and gas prices continue to remain higher. So if city gas distribution companies also go ahead and cut prices, it could be negative for their margins going forward.
All right, thanks for that, Samit. But the important point is that government may choose to reduce the taxation part of the overall fuel math, because of which the fuel price for the consumer like you and I may come down. So no possible negative impact per se on OMCs, but still we have Mr. Surana, who's MK Surana, former CMD of HPCL, to help us understand what kind of margins are oil companies making right now, what's the scope. Mr. Surana, thank you very much for joining us right early in the morning. We bother you, but this is a good news for the consumer. And even some of the economists are saying that the condition right now of the government exchequer is so healthy that they can afford a small cut in taxes without really disrupting the fiscal math. But how do you see the impact on OMCs? Can they absorb it as well?
Good morning. There are 3-4 aspects of it if we see it holistically. The first part is that the inflation commentary with the RBI gave, which was showing that probably Q2 may go above 6.2, probably that is one worry which is there. But the second worry is the crude prices have been doing up and down between somewhere in 83 to 87, which is around $3 to $4 higher than what it was last month. The diesel cracks are also formed up and the dollar prices are also high. So there is a good possibility that the fuel prices may continue to be higher in the near future. And that will give a bit of a headwind for the inflation. Now, but if we see the total inflation data, which is there for July, which is gone up, let's say, around 1.95% month to month, but year to year it is still down and the overall inflation is lesser than what it was in April. Now, tweaking the taxation is one option with the government because the possibility of increasing the prices in the election year may be slightly a sensitive issue. So tweaking the taxation will give a leeway wherein the government can manage the prices. At the same time, OMC will also have a little bit of leeway to manage the day-to-day pricing without hurting themselves too much.
Sure. The other aspect, of course, Mr. Surana, is what happens to city gas distribution plays, because for them as well, this is sentimentally negative, right?
In the sense that the competing pressure will come, and there is some disruption in the LNG pricing, especially because the Australia workers union strike threat, and that has boosted up the LNG market spot prices. And therefore, there will be some disturbances there also. And somewhere it gets connected, gas to oil. So there will be some impact there maybe to that extent. But it all depends on how the crude prices move. And there are some headwinds on the crude prices right now.
Right, Mr. Surana, just wanted to understand from your perspective as well, from the OMC's perspective, what do you believe is going to be, do you think that they would perhaps pass on the benefit completely? Are you looking at, for the CGDs as well, do you think that margins could be impacted?
No, as far as OMC is concerned, as you remember, the last year they got hurt in the process when the fuel prices were not increased for quite some time and they had under recoveries. The Q1 was good. But as I mentioned to you, and last time I also mentioned to you, that if the cracks remains healthy and the crude prices are hovering above 83, 85, somewhere range, not below 80, then there is a little bit of concern for the OMCs, and they cannot probably take the under recoveries back-to-back years, and therefore I think a part of course, the taxation benefit has to be passed on to the consumer, but maybe to some part they may have to retain if the crude prices are high.
Mr. Surana, such a pleasure having you on the show and explaining the math to us as to how this news actually would impact both OMCs as well as CGTs.
Thank you.
Thank you so much. Okay, let's move on and let's talk about all the other stocks which are going to be in focus this Friday morning. And very important news coming in. The RBI has approved the appointment of PR Seshadri as the new MD and CEO of South Indian Bank. What does it imply? Who is he? And what is his track record? Vamakshi is here to tell us all about that.
Well, yes, South Indian Bank is in focus after the company has announced that they will be appointing Mr. PR Seshadri as the MD and CEO with effect from October 1st, 2023. Now, prior to this, he served as the MD and CEO at Karur Vysya Bank, and in fact, he has worked in Citibank in various roles prior to that. Now, let's look at his track record at Karur Vysya Bank. He was appointed as the MD and CEO in September 2017, and during his tenure out there, he focused on several initiatives. The first one being the balance sheet cleanup, and that was actually visible with the kind of improvement in slippages that we saw despite the pandemic. He also undertook several digital initiatives. He implemented risk-based pricing and also launched the project NEO in order to establish new channels of distribution through digital technology. Not just that, he also implemented a performance-based incentive structure for employees in order to encourage them to put in extra productive efforts. Now, brokerages are appearing to be quite positive. They have highlighted that the selection is quite positive for the South Indian Bank, as it would mostly drive continuity of the transformation that was already undertaken by their now outgoing MD and CEO, Mr. Murli Ramakrishnan. In fact, Mr. Murli had been working on plugging the loopholes at South Indian Bank, and now when we look at South Indian Bank, it is at the fag end of its cleanup NPA cycle. There are several initiatives that the bank has undertaken in order to improve the operating efficiency of the company. And in fact, brokerages are highlighting that Mr. Seshadri could provide the much needed guidance from the top. So all in all, brokerages are viewing this development as positive for South Indian Bank.
All right, thanks very much for those details. Let's connect with Sandeep Sabharwal as well, who is joining in on the show. Sandeep, hi there, good morning. Let's get in your views first up as to what the outlook is when it comes to the entire IT basket. Are you now seeing that renewed interest, in particular when it comes to some of the mid-cap IT stocks?
Yeah, the IT stocks have been buzzing. It's like some, especially like you rightly said, on the mid-cap side have been buzzing around. But I think the macro outlook continues to deteriorate for these companies. So I think there is some sort of disconnect which is there. So I think especially on the large cap side, valuations are reasonable, but growth outlook again is hazy. So I would think that we have to be very, very selective in IT, even if people want to pick. But otherwise, the sector broadly remains a void at this stage.
Okay, a lot of other stocks which are going to be in focus as well. Vamakshi was just highlighting as to how the appointment of PR Seshadri as the MD and CEO of South Indian Bank is going to impact the bank, and what kind of weightage does he come in with. The RBI has now approved his appointment for about 3 years' time. Kunal, let me quickly get a chart check on South Indian Bank.
You know, the stock had not performed as well as compared to most of the other mid-cap banking names. in the last, I think 2 or 3 months, the stock had rallied up from, I think, 18 rupees to 2021, where the stock closed yesterday. It's still way off from its 2020, I think 18-19 highs of 34-35 for South Indian Bank. So there is a lot of hard work the stock has to do on the way upside. Hopefully that this could probably act as a trigger of a big breakout for the stock price. So, and the momentum could probably accelerate for the stock. So don't track the stock very closely, but just on the recent chart, it looks like that the stock is trying to get back into the scheme of things of trying to cover up the underperformance.
So actually, if you see when the announcement of Murli stepping down suddenly came in, that is exactly when the stock topped out, because Murli had kind of engineered a rebound for the bank from 8 to 21. That was all because of Murli, and then at around 20 topped out, and the market was waiting for what will the leadership change, which could actually be announced. So now that trigger has come, it will be interesting what kind of roadmap does the new guy give to the market, because these small cap kind of banks, look at J&K Bank, even in a bad market was up 10%. There's a lot of appetite, market wants to know more. If there is good sign that there is reason to buy this, probably interest would come. But Sandeep, there is also commentary coming in from Bata today. I want your reaction on that. Again, the entire space, all this footwear stocks, some of them were very kind of overvalued, but Bata is a old hand out there. Now they are saying that, not completely committing on that news on strategic tie-up with Adidas, but are saying, yes, we are discussing potential tie-up with multiple global peers. Do you think Bata can, regain its lost ground or the shine it used to have once?
Definitely. I think among the consumer stocks, this is one stock we have been accumulated at lower level, not at these levels. And the thesis is that on the footwear space, they have a very strong presence. Their recent forays into newer type of footwear, especially sneakers, their move into that has been accepted well by the market. The overall footwear industry has been on a slowdown in India, but I think Bata is pretty well positioned. And any such tie-up or global sourcing for the parent, which also has been under discussion for some time, but timelines are unknown, could be a significant positive trigger. So I would be positively inclined on Bata. And since they are saying that they have confirmed that talks are on, so I think that is a positive, because till yesterday there was some news flow, but we were not sure whether something is happening or not. So, and going ahead, I would think that footwear, which has been on a downturn for at least the last couple of years, will see a revival, as there is a particular cycle which plays out in footwear. So where the replacement cycle, etc., will also come about. So I think it's a reasonable bet.
Well, all that Bata has said is that they continue to explore strategic partnerships. They've not really denied or confirmed any sort of conversation with Adidas. But yeah, just a whiff of this news report did do wonders for the stock yesterday, which held out by about 5.5% on close. And I think at the session highs, it was scaling higher by almost about 6%. Naresh, you think there could be a smart follow through in Bata today after that big move yesterday?
So I would be watching out for a follow-up move if it can cross above the highs done yesterday. That would confirm that market is looking at a much bigger move here. Yesterday it made a top around 1770 odd levels, and just a couple of weeks back also it was a top around 1770. So if it can cross 1770, that implies there is more momentum to come. So we'll be looking at it as a momentum trade above 1770 levels.
Okay. Meantime, also wanted to get in your take, Sandeep, on some of these life insurance stocks. Given the fact that in the quarter gone by, you did see a pretty decent growth, the likes of SBI Life, HDFC Life, etc. What's been your assessment?
So I think essentially the cycle they followed was that they sold off after the budget, and after that there was a huge revival. At these prices, I think they factor in all the positive growth prospects of the near term. And to that extent, finding value at these prices after the rally they have seen is tough. So I think we need for these stocks to give up some gains before they again come into buy zone.
In fact, Sharad is joining in right now. Morgan Stanley has come up with its note on non-life insurance and gross direct premium income as well for the entire sector. Let me take it across to him and find out what the analysis has been. Sharad?
Well, yes, in focus we are having the non-life insurance data, and do remember that the July GDP numbers, which is the gross domestic premium numbers for the motor segment, that is up roughly 15%. But if we talk about the retail or the group health segment, that has actually outperformed, giving almost 18 to 19% odd returns on a year-on-year basis. Now, of course, the growth divergence between the public as well as the private insurers, that has actually come down in the month of July over the last previous 3 months. And let's look at the market share changes which has happened for the retail health segment. Star Health has actually maintained its market leadership, but there has been a flattish growth on a year-on-year basis. Now, when it comes to Bajaj Finserv, there has been a slight increase coming in their market share. And for the motor segment itself, looking at it, ICICI Lombard General Insurance continues to lose market share. Apart from this, even for Bajaj Finserv, there has been a slight hike of almost 20 basis points when it comes to the market share. And even Morgan Stanley came out with its report, and they have stated that this year-on-year growth was, of course, led by the retail and the group health segment, and also the motor OD, which is the own damage segment. Apart from this, ICICI Lombard actually outgrew in certain segments in the private sector, such as the marine, crop, miscellaneous, and the retail health segment. But overall, it continues to lose market share in the motor segment of OD as well as the TP segments.
Interesting. Okay, let's talk more stock specific points. And one thing which Nuresh did mention earlier in the chat in the morning is the weakness in HDFC Bank. And data is suggesting that in the last 2 weeks, there's a lot of short pile-up which has happened on HDFC Bank, which is weighing in on the bank Nifty. Pull up the last 1 month graph, you would see that from upwards of 1700, in fact, closer to 1750, the stock has been coming only one way down, almost 90 bucks. So there's not only delivery-based selling, but active shorting happening there. Sandeep, I would want your opinion on this one, because I know you're tracking what is happening and how shareholding pattern, market acceptance on this merger. Today, Investec has come out with a note saying that post-merger, P&L of HDFC could actually be lowered. And there's a lot of uncertainty and risk which market is trying to understand regarding the P&L impact post-merger. Do you expect this to continue, the underperformance, the weakness in HDFC Bank, Sandeep?
See, I think most of the analysts underestimated the impact on margins of the entire merger process with HDFC. Many people were betting on some relaxations from RBI which did not come. So their SLR, SCRR requirements at a time when the liquidity is actually tightening. And HDFC Bank, everyone has to realize, has a huge market share in the CASA deposits already. So for them to increase it further is tough in the near term, or whatever efforts they might make. So, and housing finance in any case was a business where margins were getting squeezed due to increased competition. So this merger was not in the interest of minority shareholders, and it's gone through now. So I think people have to accept it and evaluate the company as a whole. So I still believe next couple of years, at least 6 quarters will be tough for HDFC Bank. And to that extent, that's getting reflected in the stock price movement. I would think that underperformance could continue for some more time.
Are the charts indicating the same? Is HDFC Bank the weakest link within the large private banks?
Well, absolutely, yes. And I think it's been the weakest link since the last 4 or 5 months. Yeah. So, Bank Nifty, there was a phase for Bank Nifty when it started to show some signs of recovery. But then when you try and do the within the sector analysis, it was actually the PSU banks and the tier 2, tier 1 PSU banking stocks which had actually outperformed. But the large cap private sector banks, HDFC Bank and I think Kotak Bank to a larger extent, these stocks have been huge underperformers in the last 4 months. Even in this last 2-3 weeks of price correction for the Bank Nifty, majority of the correction and the weightage of the correction is because of what's happened to HDFC Bank. Stock correcting from 1740 to I think 1600 levels or sub 1600 levels where the stock was a couple of days back. So I think that's one of the major reasons why the Bank Nifty has been grossly underperforming as per expectations. And I don't see any reason why I think HDFC Bank could probably see an immediate lift off. Especially I think looking at the way the OI trends have built up, the price trends have built up, I would probably expect that the stock could just be a drag for maybe another 2-3 months or so.
Okay, that's the view coming in on some of those financial stocks. Meantime, Naresh, on the charts, let's get in a quick take on Cochin Shipyard, BEML, SCI, some of these PSUs.
So the shipyard names have already moved up really sharply in the last 2 sessions. We are up almost 20% or more on these 2 names, so still would be an avoid. But BML is the one which is still interesting. because if you look at the longer term charts, the stock had made a top around this 2000 mark in 2017, and then in 2021, and even in 2022, a couple of times around 1950 levels. And now we are at the same prices of 2000, 2100. So this could be actually setting up for a multi-year breakout. So BML could be a one which could take leadership. And going back also, all the way to 2007 also, the stock was at 1800. So that's like almost a 10 to 15 year breakout possible on BML. Sort of all the PSU names out there, BML looks the most promising one. SCI gave a breakout move on the disinvestment probability news. But the most interesting chart on a longer term basis is BML.
Okay, let's get you some more stock ideas. And here's Sanjeev Bhasin from IIFL Securities saying that it's actually SW Solar, which is one of the most reasonable players in the MEP sector for solar panels. And he's pretty confident about the prospects of the company.
It just hit 400. This will be 750, 18 crore equity. Order flow expected to be 14,000 crore in the coming year, 11-12% margin, and they are the largest or the most reasonable player in MEP, maintenance, electrical and plumbing in the world on solar panels. And you can see the ascent. As yet, they've got no order from their, parent company. So this stock is headed to double this place. Next Diwali should be more than a double play. And that would be my top pick. As a disclosure, we have a holding in that and we have a vested interest.
All right, so SW Solar is now Reliance Industries owned EPC company in the solar space, and there's good ordering happening there. In fact, there's talk in the market that they may get a large order from the parent itself. But moving on, Sandeep, yesterday SBFC, the small business finance stock, got a 40% premium on listing, but did see follow-up buying. And it was not very terribly cheap as well. I mean, just over 2 times book. Before that, we saw Utkarsh also. I mean, that was priced much inexpensive. This space, have you looked at these 2 names in particular?
No, Ajay. I looked at IPO so much.
Okay. Anything else which you like in the lender space which are catering to the MSME side? 5-Star Business Finance recently hiked their guidance to 35%. Have you checked that out?
No, sorry, not
okay,
really.
No problem.
Actually,
you're checking more of large cap lenders, I can understand. Nuresh, why don't you check the charts of Utkarsh, or maybe Utkarsh is the recent one, but 5-Star.
So we've been seeing momentum across the whole NBFC space. 5-Star is relatively just a year of data, but the stock post IPO had made a top around 657 and 650, 680. Finally broke out in July, and the trend has started, and that is the case with a lot of them one by one. So it's a trend which is going across, whether it is Ujjivan or Ujjivan Small Finance Bank, or yesterday we saw price bump up in Home First Finance. So the trend is strong across the NBFC space, and this is generally what we see. We start off with the large banks, then small banks, and then NBFCs. Over the last 3-4 months, it has been about NBFCs. So 5-Star looks interesting, Home First looks interesting. And the best still remains, the best trending one is Ujjivan Small Finance.
Sure. Okay. Sandeep, I just wanted to understand whether or not you've been a buyer at all in the recent market decline along the Q1 earnings season. Anything that you may have added positions to or bought afresh?
So my view was that we'll still see some correction. So I'm just waiting out for the correction to play out. And in terms of results, I think among the slightly larger companies which reported interesting results and outlook was Bharat Forge actually. So finally, their various diversification plays seem to be making a headway on the defense side. Also, they're making some headway. So I think this is one stock people should keep on their radar to buy on declines.
After a very long time, Ayesha, this time hiked their margin guidance.
Yeah.
From 16%, they have guided for 80-90% possibility in the next 3-4 quarters. That excited the street, and the stock saw buying even after the results. 7-8% bump up had come up right on that day itself.
But Kunal, when will a meaningful decline come in on Bharat Forge for ones to buy?
Take entry.
No, I think the decline may not come for Bharat Forge. In fact, what's actually happened is twice we've seen such kind of strong volumes for Bharat Forge, like what we saw 3 days back or 4 days back for the stock price. The last time I think we'd seen was actually a negative price action for Bharat Forge, and that was I think 4 or 5 months back when the stock was at 900 levels. From there, the stock corrected to as much as 750, which means that those strong volume days have a huge impact on the they act as inertia for the stock over the next 2 or 3 months subsequently, and the stock has a tendency of going into at least 15 to 20% of trends post such kind of strong volumes. We saw the strong volume happening for Bharat Forge and the stock closed at 960. So if we try and expect very similar, then we can expect at least another 15% up move for the stock in the next 2.5 odd months.
It's been a steady week for names like an Electra Green Tech, something like a Supreme Industries as well has gained in double digits in the markets. You've also got an IOB which has scaled up to wrap yesterday's trading session at about 31 rupees. So these have been some of the movers as well in the last 1 week gone by on the charts. But just wanted to get in your take, Sandeep. But given the fact that we have seen a lot of rush when it comes to the multiplex, the footfall seems to have recovered with the kind of film releases that we've witnessed. Hotel bookings as well, prices have spiked up quite significantly. Within this entire space, what is it that you would look at as strong opportunities, the likes of Indian Hotels, Mahindra Holidays, PVR Inox, etc.?
Yeah, so PVR Inox continues to be a reasonable bet even at these prices after 15-20% kind of rally, because people are just written off the stock in the sector, and now there's a certain rollback and things are actually much better than they ever were. So I think that's a disconnect. There's a set of people in the market who still believe that and will not buy these stocks because they believe OTT will take over and no one will go to watch movies. So I think those people won't buy, but otherwise it's a reasonable bet. Hotels continue to do well, and I think the next couple of years should still be strong for hotels. International tourism still has to pick up, and I think that could further add to gains, especially for Indian hotels coming into the winter holiday season. So Indian Hotel, Lemon Tree, both are reasonable plays even still.
Ajay, did you manage to catch Gadar too or no?
No, I didn't, but I'm waiting for this weekend.
Okay.
But there could be a little bit of Gadar in the market also. I want to get back to
You mean
Sandeep,
on the upside
on
or
the
downside?
because people are loaded. I mean, the fact of the matter is that especially the retail and HNI is loaded. And despite of the temptation to really, of course, Sandeep has been waiting it out on some corrective high, but only seasoned hands are able to book some profit and wait.
Yeah.
You need really patience for that. Bulk of the people I know in my circle are loaded with very high, mid cap and small cap basically. So, Sandeep, what could trigger this? Are you observing some of these, global headlines over the last 2-3 days? Yields are shooting up, dollar index is rising. There is a lot of risk off in the global kind of setup. But the same kind of thing, risk off is not percolating in India. Especially in the mid caps, we are seeing net inflows. Even Goldman Sachs, now Goldman is saying that FIIs are preferring Indian mid cap, small cap.
Yes, I think that phenomena, like you rightly said, is happening. Global headwinds obviously have been building for some time. Given all the points you pointed out, yield spike, dollar index moving up, possibility of slower growth, reduced earning gap between bonds and equity. I think that's a play which has been there. So that's reflected in the FI outflows out of India and the correction in large caps. Mid cap side, there's too much of domestic flow, and that's supporting many of these stocks. Yeah. So I think eventually we'll see a correction in mid caps also. Timing remains uncertain. Maybe in October, November that could happen. But I think whoever is buying very high flying mid caps, which have rallied 40, 50, 60% in just 2-3 months, they need to be ready for a 20-30% correction which can come anytime. So I think people need to recognize the risks which are there in the market also. They can't move up in a straight line always.
Yeah, of course not. In fact, we were looking at the Goldman Sachs note on pockets of mid caps where FI concentration is high. And Sandeep, you may want to comment in here. The FI favorite stock list is Max Healthcare, Shriram Finance, Axis Bank, AUSFB and Sona BLW. Interesting that, autos finds a large play, and not pure play autos, but ancillaries and financiers like a Shriram, like a Sona BLW.
Yeah, financials always have been a favorite of FIs in India, and they have made money in them also because that's been a segment which has grown a lot, and that's been a segment where new companies have come up and they have generated wealth. So I think that both in terms of private equity as well as foreign investors on the portfolio side, they have been favorites. And I think to that extent, it will continue long term also. But then at various points of time, we've seen that they become very overvalued, and some of these stocks give sharp corrections also.
Okay, that's the view coming in on some of those FI favorites and, of course, the additions that have recently been made within the entire mid-cap arena. Meantime, let's also get in a take as to what your outlook is, Sandeep. When it comes to the entire metals basket, where is it that your preference lies?
No preference on metals. I think metals and commodities in general, see, crude is being held on by the cartel, but otherwise, the commodity outlook is not positive at all. What is happening is China is going to create significant downside across the commodity world. They're already down and they remain down for a long time. The primary commodities, chemicals, specialty chemical, anything you name, it's not going to be an easy time for them.
What are the commodity users which are there on your list? Because somebody's gain is somebody's loss is somebody else's gain, right? So if commodity actually melt up the way you're making a case, it would hugely give boost to the margins of many of these commodity users. So apart from Bharat Forge, any other commodity user which you have on your list which you would buy at 20% lower?
See, many companies and many industries immediately come to mind would be tire companies. They have done well, but they could still see sustained margins. We could see improved or sustained margins in many of the automobile companies or capital good companies, because I think commodities will remain subdued for a long time. There will be spikes in between because of various factors, but directionally the trend is not strong.
Sandeep, since you do believe that the market is set to decline more, and that's the opinion even Kunal and Naresh have, where do you think are the pockets of froth? Where is it that you would say, steer clear from here?
So I think which goes around after results that worst is over for some companies and you should buy them. So I think that's a wrong thesis. So where companies are doing badly, some of those companies will continue to do badly. So this specialty chemical space, I think many of these stocks are down 30-40% from the top, but they went up they are still up 400-500% from the bottoms of 2020. And their margins are going to collapse. And this is one segment where people should just be very careful next 2-3 years still.
Yeah, the commentary from some of these large chemical players along the sidelines of the Q1 numbers has been quite weak. And it seems like it's more of a structural issue, not transitory in nature by any means. But Sandeep, great to have you on the show. Thanks as always for taking the time out. Let's just revisit what the pre-open rate for the indexes are indicating. And the Sensex rate looks more believable given the context of the global handover this morning. Remember, there's been a sharp decline for US equity markets. And Asia as well is a similar picture as we speak right now. So, pretty much in the red across the board. Hong Kong is down 1%, Shanghai a little bit soft, and similar is the picture for Japan as well as Korea too. So it seems like it's going to be a sedate start. Where we take it from there is anyone's guess. The rupee weakness as well continues, and that too is a sharp knock, 83.14, and I think it's pretty much hovering around those all-time low levels because earlier this week as well as last week you did plunge to that 83 mark, and from there we've seen a little bit more weakness actually coming in. But let's take it across and get you some of the khabar as well on D Street. And we have, before that, we'll get you some mid-cap ideas and then get you the buzz on D Street. Kunal, what's on your mid-cap radar?
So Sona Comstar is something which has looked very attractive. In fact, the stock yesterday managed to bounce back from its 50-day moving average after 2 weeks of correction. So looks attractive. The risk reward is also extremely in favor. Would suggest a buy, 595 as a target, stop us at 548.
Okay, Naresh, let's find out what it is that you're picking out when it comes to the mid-caps.
So that would be a buy on Federal Bank, which has spent almost 6 to 8 months in a very tight consolidation, multiple bottoms around 120, 23 levels, and multiple tops around 138. Over the last 1.5 months, it has gone into a much tighter range of 130 to 138. Yesterday saw a reversal from 130, 132 levels. So preempting the possible breakout of 138 with a buy at current levels, stop loss at 128 and a target price of 150 to start.
Okay. Let's tell you what is happening outside the world of markets while it seems like we're headed in for a flat start once again. US President Joe Biden will be hosting the leaders of both Japan as well as South Korea in a first of its kind trilateral meeting today at Camp David. The president is hoping to smoothen the historically icy relationship between the two neighbors in order to try and bolster military cooperation in the region amid rising tensions between China as well as North Korea. Also keeping it with politics then, expansion of BRICS will be in focus during the 15th BRICS summit in South Africa next week. The 5 member states are yet to reach common ground on the expansion issue. Remember, some 40 countries have reportedly expressed an interest in joining the summit this time. Also, China's Evergrande, the world's largest or most heavily indebted property developer, has filed for protection from creditors in a US bankruptcy court. The company has sought protection under Chapter 15 of the US Bankruptcy Code. This filing comes amidst growing fears that problems in China's property sector could spread to other parts of the country's economy as growth slows.
Meantime, Bengaluru will witness a unique celestial event today, the Zero Shadow Day, which is to be witnessed around 12:24 p.m. to be precise. Remember, this celestial event occurs twice every year, and Hyderabad has experienced this previously this year. And Mumbai once again has topped as the most expensive city to live in India. This is as per the Knight Frank Affordability Report. Meanwhile, Ahmedabad has been ranked as the most affordable city. And interestingly, Mumbai's affordability index has steadily improved over the last 10 years, going from 93% in 2010 to the current level of 55%.
All right, so move on and get you some juicy gossip right from the dealing rooms. We have Sharad who's getting us a stock which is gathering a lot of interest from institutional shareholders. Sharad, tell us, what's the stock on your list today?
Well, yes, the stock is Endurance Tech, and the company is likely to win a large EV order coming in from the European segment. Now, do remember that the channel check suggests that recently the company had actually won a large order coming in from Honda, and this is coming for the e-wheeler segment, for the two-wheeler segment. Apart from this, the rising demand is coming in from Bajaj's Triumph as well as Hero's Harley, which might aid sales going ahead. Apart from this, also looking at the channel checks, the EU order wins are rising, especially in the proportion of the electric vehicles, and also for the brakes and suspensions, a good deal flow is coming in from the two-wheeler segment. Apart from this, of course, the easing semiconductor issues has actually aided in uptick of registration in the European markets, and Q1 numbers recently came, and a pleasant surprise beat was there on the margins, especially on the operating leverage front. Apart from this, there are certain risks involved in the stock. These include client concentration, capex-led growth in the European markets, and slowdown in the Indian two-wheeler industry.
Thank you very much for that. Endurance Tech is the stock to watch out for. Nuresh, two mid-caps I want to discuss with you. Mid-cap, in fact, they are small-cap ideas, but would be in focus. And first of them is Repro. Repro is in focus. They've done a preferential issue. But one of the names among investors is Madhu Kela, almost 50 lakh shares being picked up in pref in Repro. Can you check the charts of Repro? How do they look?
So the stock is interesting for the fact that it's taken 5 years to come back to those 2018 highs. So 2018, 17, 18, the stock made a top around 850, corrected down to 350 in 2020, as well as in 2023. We were at 350 levels. So it's been a strong recovery in the last, say, almost 6 to 8 months. And now we are back above, closer to 850 mark, which was the previous high. So generally, when you cross a 5-6 year high, it's a positive case for the long term as well as for the short term. So looks promising. And over the last 1 month also, it consolidated between 730 to 830 levels. So it's consolidated near the all-time highs as well. So it could surprise on the way up. Could be a stock which could go towards 1,000 odd levels in the short term.
Okay, that is Repro India. But Kunal, what about DB Realty? Yesterday, there was a block of 40 lakh shares in DB Realty which has happened, and the stock got locked on upper circuit. The data now shows that Autumn investment actually picked up almost in that entire block actually. So may witness some action, but what do the charts tell?
I think it finally makes the stock look very attractive because it's come back towards a breakout point. So the breakout point for DB Realty 2022 high was I think 138. The stock is closing at 132 levels. The 2016-17 high for DB Realty is around 164 mark. And it's not a stock which has been hugely underperforming, but it's a stock which is actually remaining a bit more sideways. Hopefully that this trigger could probably lead the stock into a breakout. And the next set of targets then we could be looking out for would be around 160-64 mark for DB Realty. I am extremely bullish on the entire real estate space, specifically DLF, Anantraj Industries have been two of the picks which have been highlighting time and again. I think DB Realty also tries to enter into that category of a strong breakout list on the longer term charts.
Kunal, let's also, I remember we've been discussing Anantraj from 80-90 bucks. Yes. There's another stock close to Anantraj, that is TARC. Okay. Can you check the charts? This is actually the demerged arm of Anantraj when the the arrangement happened between the family. The TARC became another demerged entity, again listed, and one became Anantraj. Anantraj has rallied quite a lot in the last 1 year. Can you check the charts of TARC, because there is some initial current which seemed to have started in TARC as well.
Well, yes, so I don't track the stock very closely, but then as you were saying, I was looking at the charts, and from a 35-38 level, the stock is almost at 80 plus. So it's gone to a different, orbit as such over the last 4 or 5 months. And I think majority of the rallies happened in the last 4 or 5 months for TARC. Prior to that, the stock was almost sideways for last 1 year. So this seems to be like a very strong breakout for TARC.
Yeah, just urging you to wrap it up because you don't seem to have that stock in our database right now, but maybe refresh our systems and add it in. Meantime, Naresh, just curious to get in your take as to what the outlook is when it comes to the auto stocks, because without a doubt, they have been one of the top performers in the year gone by so far. Do you think that there's still merit in buying into auto stocks at the current levels? And if so, which would they be?
So in the auto pack, there is clear leadership. Mahindra and Mahindra was the leader, took a pause for a few months and back into leadership. Then you have Escorts, Kubota, which continues to make new 52-week highs. The new leader in terms of a recent breakout is Ashok Leyland, which broke out above the 170 mark. That has started a trend which could slowly and steadily continue. So in terms of preference, it comes to Ashok Leyland and Mahindra. Then in terms of a dark horse, it is Hero MotoCorp, which has gone through multiple years of consolidation and is now trying to make that move about 3,100 mark. Closer to that area only. So this is a stock which could surprise in terms of upside. The stock has consolidated really well. The next one is on radar is Maruti, which topped out at 10,000 a few years back. Recently also topped out at 10,000. Whenever that can cross 10,000, it creates a new trend. But as of now, the strong trending ones are Ashok Leyland and Mahindra.
All right, let's move right on and find out what exactly the index strategies are or index calls are. And what our chartists are advising, given that perhaps now we're in for a change of tide. Questions are still arising regarding that with respect to the market momentum, despite the fact that we managed to hold out so far. No trade, that's exactly what Kunal and Naresh have been saying for the past few days. It's a hold call from Kushbora, that's the advice on the frontline index, and ditto when it comes to the Nifty Bank.